Hi, I'm Brendan Lee. I'm with SunCal Real Estate Group. I'm here with Keith Collins of Alpine Mortgage Planning. I just wanted to actually share some useful information with you. I'm not a mortgage guy. I'm not a loan officer or mortgage planner. So I want to get an expert in here to really explain what your interest rate is to you. How is it actually calculated, and how does that apply to you? Because I'm sure that you know that there are different people, depending on the situations, that get different interest rates on their home loan. So Keith, can you talk about that?
Yeah, sure. So what I'm going to talk about, the direction I'm going to go with this is not so much where the mortgage comes from. I'm not going to talk about the bond, but how I actually offer an interest rate to a client, right? Where does that rate come from? And what there is we call them loan level pricing adjustments. And basically it's an adjustment to the interest rate for different scenarios going on. One of the biggest ones is owner-occupied versus investment property. So someone's going to live in the home, or someone's going to actually rent it out and make it an investment. And the reason these adjustments are there is because one loan is more or less risky than the other.
Right.
A less riskier loan is somebody's going to live in the property as opposed to somebody who's going to rent the home out. Because if they get into financial trouble, what are they going to get rid of first? They're going to get rid of the investment property as opposed to the primary residence that provides a roof over their head. So there are these loan level pricing adjustments that we have to do, and I got to say there's 30 plus every time we price out a scenario. So is it a single family home, right? Is it a duplex? Is it a triplex? Is it a fourplex? How much are they putting down? 5, 10, 15, 20% down, 25% down. Each time you go through one of those increments, the pricing on the loan changes.
Sure.
What's their credit score? 740, 720, 700. So all those types of things go into us determining what interest rate we're going to offer. It's not me just looking at paper saying, hey, I'm going to give this guy a 5.5 and I'm going to give this guy a 4.5. We actually plug in the details of the scenario, and then we price out about 45 different lenders, and it kind of spits out who has the best rate for the day based on that individual specific situation. So that's where I find sometimes people come, with a predetermined idea of what interest rates are going to be, and it might be a lot different than when they're getting offered, because they're just going to the Wall Street Journal, which is telling us what the average interest rate was for last week across all mortgages originated.
Right, and that's huge. I think he brought up a really, really good point. Just because you see an interest rate online does not mean that's what your interest rate is going to be. It's really specific to a situation.
Correct.
So,
and also the cost associated with that loan. A lot of times someone will advertise an interest rate online and there's a point plus an origination fee. Most of the time when we start with an interest rate that we're quoting to somebody, there's absolutely no origination fee because we're a mortgage banker, not a broker.
Right.
And then I always start with a no-point scenario. I try to show them the lowest cost scenario that we can get them into, and then from there we'll talk about other options.
Perfect. Well, that was really useful information. I hope you got something out of that. And Keith, I appreciate your time.
Yeah, thank you.
Thanks.